Hello to you all. Welcome to another lesson from the advanced part of options trading. And in this case, we are going to speak about the strategies that we are going to use. I want to say initially that there are more than 50 strategies around that someone can use, for the option market. However, I'm only going to focus on 3 of them, which in my opinion, I believe they are, I would say, one of the safest and the easiest, while at the same time producing the same type of rewards monthly or yearly as just like any other one. So yeah, let's get on with it. Those strategies are going to be a short call, vertical spread, a short put, vertical spread, and an iron condor. So yeah, don't worry, I'm going to explain you everything there is to know about it. The short call spread. Yeah, I missed the title, sorry. So yeah, the short call spread. In the case of the short call spread, we are going to perform 2 operations at the same time with the call option. We are going to first sell a call option, and after that we are going to buy with some points upper a call option. In this case, negating, I would say, part of the risk that we would have initially using a naked trade, while at the same time requiring much less capital than we would normally require with a naked trade. So the directional for this type of trade is neutral to bearish. I'm telling neutral because if the price is going to stay on the same place when you are going to perform the trade, and even if it goes slightly against you, you are still going to end up in profit. The type of implied volatility environment, initially I would say high. However, during my test for the last 15 to 20 years, I noticed that it tends to work in almost any type of environment. The max profit that we are going to get is the initial credit we are going to receive when we are putting the trade. The maximum loss which we are going to lose is going to be the wide of the spread, which we are going to, aka the difference between the call sell and the call buy. And the profit target, we can start from 50% of the credit, and also the other option is to just let it expire and receive the credit, the max profit. So yeah. The setup for this, as I said, we are going to sell an out of the money and around the money call. However, in general, I like to trade around 20 to 30 delta call. And I'm going to buy around 5 to 10 points different. So if I'm selling a 20 delta call, I'm going to buy a 10 delta call. So yeah, they are very easy. I would say, better said, they are pretty black and white, yeah. And in general, we only focus on out of the money credit spreads. Let's take a look into them and see how. So let's finish first, I would say, with the definitions, and after that I'm going to perform each and any one of them in a broker. The other option that we have, the short put spread. This one, instead of using a call option, we are going to use 2 put options. In this case, the directional assumption that we have is neutral to bullish. One moment, please. Because like I said, if the market is going to stay side market, it's going to stay flat, we are still going to collect that credit. And if it's going to go like we predict in the bullish, we are also going to collect that credit. We are going to lose the money when it's going to go against us, and in this case it's going to be, of course, the difference between the put buy and the put sell, and the put buy. The max profit, just like the short call spread, is going to be the initial credit which you are going to receive. The max loss, of course, is going to be the wide of the spread minus the credit received. And the profit target that we have, just like the other one, we can go for half of the initial credit, or we can just let it expire and take the entire profit from the credit. So yeah, just like the other one as well, I'm using 20 to 30 delta out of the money, and as well I'm using a difference of 10 delta between the initial out of the money put sell for the buy put as well. So to make a resume of the spread trading, you know, the vertical credit spread, it's a premium selling spread, because our aim is to win small but win very, very often. So in this case, we are going to collect the premium. That's going to be our, you know, our profit. And it's at the same time, the best scenario is that when the spread is going to expire worthless, or when we are going to buy the spread for less than we sold it for. In general, it tends to be a value, you know, close to the expiration. So the higher the implied volatility, the more credit we are going to be able to collect from selling of the spread, and further away we can go get from the stock price. At the same time, the wider the spread, the less we pay for our long option protection in both put and call credit spreads, which is going to give us a much bigger potential profit, but also we are going to have the potential to lose much more if the trade goes against us. So we are going to take more risk for more credit. So yeah, in a way we kind of have to find a sweet spot. And don't worry, I'm going to explain about what's my sweet spot later on as well. So yeah, in the vertical credit spread, the short option is the asset. The long option, essentially, it's an insurance for us to not act like a naked trade, and at the same time to diminish the margin required to perform that trade. The max profit is going to be the credit from the spread, just like selling a naked option. And the max loss is going to be defined by the distance and the width of the spread, subtracting the credit received from the trade entry. So yeah, because I'm finished with this one, let's take a look at the broker. So let's go, for example, in this case with, let's go with Meizu. So in this case, like I said, I like to perform out of the money. So in this case, for example, if I believe that direction is going to be bullish in the next month, and I want to sell this credit, I'm going to go on the put, and I'm going to sell for 250, and I will buy it back for 230. So in this case, you can see, let's see the difference. Like I said, the put sell, it means that my direction is bullish, and I estimate that the price is going to be higher than 432 in the next month. And on 2 of May, the price, I believe, is going to end up superior to 432. But if I will put only the put sale, if you noticed, in this case, I would receive the credit of 2.57, which we can see from this part here. So we can see that 2.57, it would be our max gain, because it's the credit that we pay and we get initially. However, our loss, you can see it's unlimited. You know, if it goes to 400, for example, we can lose almost 10 times more than what we gain, even more than 10 times. So for this, we are going to buy a put. So let's consider, for example, we can take from 442, let's go, for example, with 428. You can see in this case, for example, a distance of 5. Let's take one a little bit more. Something like this. But yeah, maybe instead of, because I want the delta difference of 10 points, we can go, for example, with this one actually. 415, 416. Yeah, something like this. I believe it's very good. So we can see that in this case now, our risk is defined, not anymore. So you can see that we are going to get the initial credit, and this initial credit is calculated from the bid price of the sell, which is 250, minus the ask price of the buy, which is 123. So in this case, it's going to be 132 approximately. And this 1.32 is going to be the credit that we are going to receive in our bank if we are going to be profitable. But now you can see that the max loss that we are going to have is going to be only 1.5 thousand. We are not going to lose ever more than 1.5 thousand. Because of this put here on 4.16 is going to help us to negate that loss which would happen if the price would continue to go against us more and more and more. So you can see at the same time that the smaller the wide, like for example, I would use only a difference of 5 delta. You can see that in this case, I would only need to put $400. The maximum I'm going to be able to win in this case is going to be the credit, which it would be $68, and the maximum I'm going to lose in this case is going to be 600. So yeah, I have a probability, for example, of 90% in this case of winning $70. I have a 5.3 probability of losing $632, and then in the middle chance I have this probability of be anywhere in between, you know. So yeah, but honestly we can also put stop losses, you know, in this case. But for that one I'm going to explain in the premium lessons. I'm sorry. But yeah, just so you know as well, there is a possibility for you to apply take profit into them or stop losses. The take profit, for example, in the near days, in the future days, let's see the credit, for example, the price of it is going to be 34 instead of 68. Then you can put a take profit, take those 34 and exit for the trade for 50% gain on the trade. Or also, for example, you can put a stop loss of 200 or 300% the initial credit that you paid. So let's imagine, for example, the price is going to go like here on 428. If you would have a stop loss, you can exit here, so you would lose 3 times only what you would this, while still maintaining the 90% probability. But yeah, in that case, it's going to go a little bit lower. It's going to be 85, 84, but it still is going to be amazing risk-reward ratio over a long period of time, of course. So that's why you understand now why it's so important from the beginning to calculate the mass leaks that you put, the percentage total, you know, to be a certain percentage of your capital, you know, and all this data. So in this case, if, like I said, this, if you would have a bullish mentality. But now let's imagine, for example, we would have a bearish mentality. So we would go on 470, for example. Yeah, we can go on 470, and the same, we would sell a call on 470, and you can see that initially the same, we would pay a huge margin, 3.7 thousand we would require. The same style like before, we can see that the maximum we can gain is 118, which is the price of credit, but the maximum loss, it's unlimited. So yeah, so because of this, what we are going to do from 15, we are going to go, let's say for example 10 delta, and on 10 delta we are going to buy a call. So in this case, you can see now the maximum that we can win is going to be $43, but the maximum that we can lose as well is going to be defined from the beginning, which is going to be 500, how much is it? 257. So yeah, you can see that now we have that probability of loss capped. So now if you noticed, we have a 78% probability of winning 43 and 70% probability of losing 257, which will be the entire margin. So yeah, this is the credit put and the credit call spread. and we can see how they help us to negate, you know, those values and help us, you know, because we know from what we saw previously from the implied volatility that being a seller is going to beneficiate us in the long term. However, if we are going to take a proper risk management with us, we are going to increase that even further, that chance. So yeah, let's get back. The last one that we had right now, we are going to speak about the Iron Condor. The Iron Condor in the end is no more no less a combination of both credit spreads. So we are having a put credit spread and a call credit spread. So in this case, we are going to have, I would say, neutral assumption of the market. We believe that instead of being bullish or bearish, it's going to stay between a range of price. Like for example, we can estimate that this is 400 and this is 500, and we believe that SPI, for example, on the next month is going to be between 400 and 500. The benefit of it in this case is that we can receive double the credit, you know, because we can receive a credit from both sides. And also another advantage that it has is that one side is always going to be correct, because we can only be wrong with once. The price can either be here, here, or here, you know. So it cannot be on both places at the same time. So yeah, the type of environment, in this case, you know, although here is written high, you can also trade with low environment as well, especially if it's a side market and you don't expect big movements, you know, it's going to help even better. Yeah, the max loss that we can have is going to be the credit, you know, from the both. No, the max loss that we can be is going to be like the max loss from a credit pulled spread or a credit call spread. Because, like I said, one of the parts is going to be beneficial for us. And the same, if you want, you can put a profit target of 50% of the credit received. The Iron Condors are neutral trades and they reach max profit at expiration if the stock is in the middle of the strikes. They sustain losses when the stock price is beyond the break-even point of the in-the-money short option. The max loss occurs when one entire spread is in the money at expiration. At the same time, the max loss can be different on either side if the spread are not the same width. The wider the spread, the more risk there is on that side. So let's take a look. Let's make for this one the same. I'm going to sell a call on 20 delta and I'm going to buy on 10 delta, and then the same for the put. I'm going to sell a put on 20 delta and I'm going to buy a put on 10 delta. So you can see in this case our total margin required to be 673, which it would be the margin. We can see that the price, it would be 251. So 252 is going to be our max loss, our max win, sorry, that we can have. And we can see that if the price is going to go this way, we would lose $350, but if the price go this way, we are going to lose, well, no, this is for 5 of April here, yeah. So if it's going this way, we will be able to lose a little bit more than the other one. So yeah. But however, in this case, I don't understand this calculation. It shouldn't be this way. These parts, in theory, they should be equal. But I believe the O is because of the strike prices which I chose. But yeah, more or less, you can have an idea of how it goes. But as well, the max loss in this case, you can see it only has a 3.7% chance, you know. So yeah, there is that as well. Or I believe was the delta, because there is a little bit difference between the delta and the theta that we have into them. So yeah, this is going to affect as well. So that's why we don't have the equality in the both scenarios. So yeah, for example, if I would use a 10% movement or a 5% movement, you can see with a 5% movement from where we are right now, this is our range of profit. It would be from 470 until 433. It would give us this entire place for the profit. So yeah, this is what we have for the 10%. You can see it better. It'll be something like this. So yeah, this is the Aero Condor. Yeah, I would like to thank you again for watching. You can find more details on thetraderlife.com. If you have any question, contact thetraderlife.com, and you can find me also on Telegram at SoftKills21. So yeah, see you next time, where I'm going to put everything together and I'm going to help you how to make a trading plan. And yeah, see you next time. Thanks for watching. Bye bye.